There are two camps in the finance world: growth investors and value investors. This video is going to investigate these two camps. What are the differences between the two? And which is better for you as an investor? Both schools of thought are backed by some heavy hitters. Take, for example, Warren Buffett, who is arguably the most successful value investor of all time. On the other hand, investors like Cathie Wood have characterised growth investing in recent years, taking part in the spectacular rise of technology companies. Stick around to the end of the video to learn more about the sweet spot between growth and value that could also work well as an investment approach for you. Let's start with our definitions. Growth investing is defined as investing in companies that are poised for growth. The goal of this investing strategy is to increase investor capital. In order to achieve this goal, a growth investor will typically search for small or early stage companies that have the potential to increase their earnings significantly. The pull of growth investing is the potential for significant returns. But with the potential for high returns also comes high risk. Early stage companies often have low profit margins, smaller customer bases, and are at risk of going bankrupt. Opposing this is value investing, which involves choosing to buy companies that are good value. These companies are usually more well established, with less opportunity for growth, but higher profit margins and a greater ability to pay dividends. The value part of value investing is the implication that buying these companies is a good deal or good value. They are assessed as being underpriced based on their fundamental qualities. You can do a quick sense check as to whether a stock is value or growth by looking at the PE ratio. The PE ratio is a measure of a stock's price compared to its earnings per share. The measure shows how expensive a stock is relative to the profit it makes. You can calculate the PE ratio by dividing the share price by the earnings per share. A low PE ratio represents a company that is cheap relative to its earnings. A high PE ratio represents the opposite, a company that is expensive relative to its earnings. As a rough guide, sliding lower along the PE scale means that the company is more likely to be a value investment. Sliding higher along the scale means the company is more likely to be a growth investment. At the moment, the PE ratio of the largest 200 companies in Australia sits at an average of 16 times earnings. This can be considered, generally speaking, quite a low PE ratio and closer to the value end of the scale than the growth end of the scale. This lower ratio reflects the nature of large Australian companies. They are well-established businesses, like banks and mining companies, that have few innovative growth opportunities. But consider the makeup of an index, like the NASDAQ 100, which contains a number of technology companies, like Apple, Amazon, and Tesla. The NASDAQ has a PE ratio of 32 times earnings, reflecting the opportunity for growth, which is built into the price. So, which is the better end of the scale to be on? The answer is, it tends to vary over time. Because of the incredibly strong performance of a number of US technology companies through the 2010s, growth outperformed value. These companies were rewarded by the market as their earnings continued to grow. A low cost of borrowing also allowed them to take on large-scale projects using debt. But when interest rates began to rise in 2022, the tables turned. Growth opportunities started to diminish and value started to outperform. We see here that even in this relatively short period of time, the 2010s and early 2020s, growth and value both had different points of outperformance and volatility. The benefit of growth companies is, of course, growth. Potential capital gains are higher, but it comes with the risk that projected growth is overstated. The fact that so much of growth companies' price is dependent on their ability to actually grow also means that when broader economic growth is slowing, prices can take a hit. The benefit of value companies are they tend to hold less risk than their growth counterparts. Additionally, the premise of value investing means you are buying companies at a perceived discount to their intrinsic value, which could lead to a realization of that value in the future. The downside of value investing is the risk that this value is not realized. Sometimes, companies are cheap for a reason and could be on the verge of bankruptcy or have declining prospects in the future. These companies are known as value traps. There's no real winner in this debate. Some investors prefer the idea of seeking out a stock that's undervalued and purchasing it until it fulfills its value. Others like to seek out growth opportunities that offer high risk-reward profiles. Many investors, however, take a hybrid approach to stock investing. Consider the GARP investing philosophy. GARP stands for growth at a reasonable price. Growth at a reasonable price takes characteristics of both schools. Popularized by the legendary investor Peter Lynch, the strategy seeks out companies with high growth potential that might have been undiscovered by the market. These companies are usually on the lower end of the PE ratio scale, but offer unique products or solutions that would usually place them in the growth category. In this instance, investors get benefits of both schools of thought. You can get exposure to companies that have potential to grow their profits, but you also get the value characteristic of buying at a good price. Whether you're a growth, value, or GARP investor, our goal is to help you build wealth over the long term. If you're just starting out with your investing journey and looking to learn more, have a look at some of our other content on the channel. Thanks for watching.